welcome to the special edition of the Global View with me, Tanveer Gill. My guest today on the show is Krishna Memani, who's the Chief Investment Officer of Oppenheimerfunds in New York. Krishna oversees allocation in his role as CIO of over $220 billion. Oppenheimerfunds has about $4 to $5 billion invested in India. And of course, Krishna is here to talk about the impact of the US election result on the US markets and the US economy, plus the impact that result may have on emerging markets like India. Krishna, it's great to have you on the show. Thanks very much for taking out the time. The top question really is, how are you viewing the fierce battle to the finish, as we are calling it? Now, the market understands what a Clinton victory would mean in terms of market sentiment and the reaction thereof. But explain to our viewers, what would a Trump victory result in terms of a market reaction? Because, the opinion polls are indicating, once again, a slight lead for Clinton, but it's still seeming like a neck-to-neck battle.
So the markets are still very much expecting a win by Hillary Clinton. The magnitude of that win has certainly gone down and the race has certainly tightened, but the base case still is very much about Hillary Clinton winning. If Trump wins, and the probability of that over the last few weeks has certainly gone up, if Trump wins, that is going to be bad for the markets in the short term for sure. Again, as I have mentioned before, it'll be like Brexit. Not because a policy 2-3 quarters from today is going to be worse. It is just uncertainty. It's you just don't know what can happen in terms of policy and what he does, and that alone will take the market down.
Right. Krishna, but help our viewers understand, what would be the immediate market reaction in these three scenarios? If Clinton wins with a slim majority, if Clinton wins with an absolute majority, which is more than 300 seats, or if Trump wins?
So those are really the three potential scenarios at the moment. A Clinton win with a slim majority is basically the base case in the markets. And because we have priced in a potential for a Trump win over the last few weeks, we priced that out so the markets have a modest rally as a result. A substantial win or a clean sweep by Clinton with a potential of a Democratic House is certainly not something that the markets are expecting. And that it gets tricky there because while the majority would certainly help from a fiscal standpoint, I think the markets probably react negatively to that, primarily because it entails some level of tax rises, which may end up being a fiscal consolidation before we figure out how she's going to go out and spend the money. So my expectation would be that, again, the markets react negatively, but modest negative would be the outcome. A Trump win, on the other hand, is going to be a substantial negative for the market, primarily because it's basically uncertainty. I think longer term, some of the Trump policies may end up being positive for the economy. However, before we get there, we have to deal with the fact that this is something that we hadn't expected. And secondly, it's definitely trade negative, and the initial reaction is going to be very, very negative. Much like Brexit, probably 5 to 10% drawdown on S&P 500, and similarly a broad-based sell-off of all risk assets on a global basis.
Would you expect a very adverse reaction from emerging markets like India as well if Trump becomes president?
Oh, absolutely, absolutely. Emerging markets of late have done very well, and anti-trade policies that Trump has been espousing for quite some time is emerging market negative. So I would expect emerging markets to be underperforming in that environment more negatively than U.S. equity markets.
Sure. Krishna, in an excellent note put out by Oppenheimer, you have compared how the Reagan era and the Obama era, despite being poles apart, gave supernormal returns to investors of nearly 150% through the 8 years that both these presidents were in office. What can one expect from the next president's tenure, extrapolating from that data? Because the new president will come at a time when markets are trading at record highs, unlike what happened at the start of Obama's tenure, as also President Reagan's tenure.
Sure. So I think the Reagan era and Obama era were on the back of market environments that were very negative when their regimes started. Therefore, the reaction was quite positive for 2 terms for both of them. But I think the key thing to remember is for long-term investors, politics in the U.S. really has not been a determining factor with respect to returns. The magnitude of returns certainly matter. That is, beginning at the current levels in markets, expecting that you will get similar returns like the Obama administration with Hillary Clinton is probably unrealistic. However, I think getting positive returns and decent positive returns is still very much in the cards, and they're very much in the cards with Clinton, and I think I can make a good case that they're very much in the cards with a Trump administration as well. It'll take longer, and we may go lower before we go higher. So in the end, the who wins the election for longer term investors may not matter that much. The policy direction to some extent has already changed, and I think the next 2 terms, if these folks end up with 2 terms, will probably be, from a policy standpoint, will probably be heading in the same direction, and that matters more than anything else.
Sure, but Krishna, add in your perspective over here. What would a new president mean for the economy struggling at 2% growth, is at near full employment levels, unemployment at about 5% odd? Labor participation is at, a 30-year plus low. Inflation is picking up, but that's because of a rebound in oil and commodity prices. Join the dots for us. What can the new president do for the U.S. economy?
So I would say that the case is exactly opposite of the points you are making, which is when Obama administration came to power, at that time the task at hand was pretty well defined. So which was, you basically have to have a temporary fiscal stimulus to climb out of the deep hole that the economy had fallen into. So there was really only one way out, and that's what they did, and we got really good returns out of it. I think what is different this time around is, despite the fact that the growth rate is at 2% and inflation seems to be picking up, I think those are really temporary factors in the following way. I think if we have a substantive fiscal policy initiative, and I think it is quite likely that under either administration we get that, if we get that, then we can change the direction of the 2% growth assumption that everyone is making. The U.S. economy at its core is strong enough, and it can probably get to 3% quite easily. But for that, it needs the policy stimulus, fiscal policy stimulus, that it did not get in the second Obama term that it so desperately needs. So, and as far as inflation is concerned, I think on a global basis, the inflation that everyone is talking about is really commodity price inflation, and that is base effects. That is going to fade. The globe is still awash in savings, and it's still aging. So the likelihood that inflation is a long-term phenomena, I just have a hard time believing. Inflation was a 70s and 80s bugaboo, and we continue to fight that without any manifestation in reality.
Krishna, you gave me the cue for my next question. What would the new president's appointment mean for the Fed's outlook on rates? The market believes that a rate hike in December is very much on the table. But what if Trump becomes president? Will it mean more rate hikes or less? Because, the opinion there is not very clear. Trump has been quite vocal about what he thinks with regards to the functioning of the Fed. He's been a bit contradictory in saying sometimes that he prefers low rates, and then saying that rates should be hiked given the state of the economy. So how would the Fed move once the appointment is clear?
So I would say that monetary policy regime under either administration is still going to be an independent phenomena. That is, I think the likelihood that either of them will be able to dictate what the monetary policy is going to be on a forward-looking basis, I believe is still very, very unlikely. So the real question is, if there is a fiscal stimulus, what does the Fed do? And I would posit that in the initial go-around, that is at least for the first few years, as this policy unfolds, the Fed will probably stick to its current timetable of going down the path of very slow rate rise regime. And that makes sense from the following standpoint. That is, the Fed has been arguing that it has carried the ball by itself for the longest time. It needs help from fiscal authorities. And the moment fiscal authorities arrive, if it starts pulling back and that kind of takes the economy down, they really don't want that outcome at all. So I would expect them to continue down the path of very gradual rate rise. You know, in 2018, the situation may be very different. Participation rate might have increased. Overall core inflation may be closer to 2%, and we may see a higher trajectory in rates. Modest higher trajectory, not a substantial higher trajectory in my view. And as far as December is concerned, I believe by now the markets have spoken. Today, we are dealing with the unemployment report coming out in a little while. And that'll probably determine whether the Fed raises rates or not. If the Fed actually raises rates in December, in my view, it precludes it from raising rates in the first half. Earliest then it can raise rates in 2017 will probably be June. So the choice for them is December or later in the first half. If they pull the trigger in December, I think the trajectory gets extended a little bit.
Right, Krishna, then my only follow-up question would be, should the Fed move faster in 2017? Should they go ahead with more rate hikes if the local economy is looking good, but they have to contest with the global environment where, in contrast to what the Fed is doing, all other world central banks are still in easing mode? What would a faster move on rates also mean for emerging markets?
Sure. So that really has been the innovation in the Fed's thinking in late 2015 and more importantly in 2016. That is, the international context matters. And Lael Brainard, who's the Fed member of the FOMC, who's been driving that logic, has kind of articulated that very well. That is, if the rest of the world was raising rates and the U.S. Fed raises rates at the same time, the implication of that would be significantly different than the Fed raising rates by its own. The impact of that in the current environment on a global basis, where we are awash in savings and aggregate demand is what we are missing in the world. In that environment, if the U.S. raises rates, effectively the dollar will strengthen and it'll take down the U.S. economy. And that taking down would happen not just through the external channel, that is not just through exports. It'll happen because it'll create turmoil in financial markets, and as a result, U.S. savings rates would go down and U.S. growth rate, savings rates will go up and U.S. growth rate as a result will go down. And I think that is a very robust argument, and that holds today, and that holds irrespective of whether Trump wins or whether Hillary Clinton wins.
Right. I also want to ask you about what will happen to the dollar if either candidate wins. What is the current dollar strength reflecting? Is it just safe haven buying, or are investors seeing value in U.S. assets through this period of transition?
I think dollar strength right now is really more about risk off than anything else. So, it's basically, people leaving EMFX to come to the US dollar. And it's very modest. I think the true dollar strength that we fear is rate rise driven dollar strength. And the magnitude of that will be quite substantial. Perhaps not the 20-odd% that we saw from middle of 2014 to early part of 2016, but substantially more than a couple percentage points that we have seen so far.
Let's talk about what the election outcome would mean for the rest of the world. What would a Clinton victory mean for emerging markets versus a Trump victory?
Sure. So I think there are a couple of things to consider in that regard. Emerging markets right now have momentum going into 2017. It's a revival in commodities, it's stimulus in China, and it's growth in certain countries, or at least stabilization of the negative trend in countries like Brazil and Russia that we had seen before. So emerging market growth has momentum going into 2017. And if Clinton wins, then that momentum can manifest itself with better return prospects for EM equities, and India certainly would participate in that. So I think if the base case comes about, we make back all the losses that we have had over the last couple of weeks, and then we continue down the trend that we had, which was emerging markets was ending up as being the best performing asset class on a global basis, both on the fixed income and equity side. And I expect that to be the case at least for the first half of next year. If Trump wins, that changes dramatically. That is basically anti-trade policies, and anti-trade policies are hugely EM negative, at least in the short run. My expectation would be that a President Trump would be very different from a candidate Trump, and that anti-trade rhetoric will probably fade over time. But initially, I think the way it'll work out is EM negative rather than EM positive.
And talking specifically about India, whose presidency would be better for India in terms of improving bilateral relations between the two countries?
Well, so, I think from a geopolitical standpoint, some of the things that Trump is articulating probably works out in a positive way for India. But I think from an economic policy standpoint, it's very difficult to say that anything if Trump does anything that he's saying that he's going to do ends up being positive for India. I think economic policy outlook for India is the best case is status quo, and that's Hillary Clinton. Political standpoint, I think Trump has some really unique attributes that policymakers and politicians in India may find attractive.
I just want to take up a few more questions in India. GST has come through, Krishna. There's some ambiguity remaining on the control issue. But would timely implementation of GST, which is essentially meeting the 1st April 2017 deadline, mean that you revise your earnings outlook for the region for FY18 would then get adjusted to the upside one may see on the index?
Well, so I think implementation of GST is a longer-term positive rather than a shorter-term positive. So I think the growth momentum in India is very much in place, and that continues. And GST may help it a little bit, but I don't think in the short term it really changes the direction. I think the true effect of GST really would be felt over the next 5-10 years as opposed to 2017 or 2018. The challenge for India is to implement these policies far more rapidly than they are able to do for all sorts of reasons, and that kind of puts investors in a bit of a bind. we all want to believe in the longer-term story in India because it's really the only longer-term story that is left in the world. The challenge is, would Indian politicians implement the policies that they need to implement for this longer-term growth scenario to pan out? And would they do that quickly enough?
Sure, but Krishna, for somebody who manages $4 to $5 billion in India, what would make you increase allocations to the region? You know, the top three ideas or suggestions that you have for the government as it completes 2.5 years in office, midway through the tenure, what is it that you would advise the government to focus on that would draw more investment for foreign investors such as yourself?
Sure. So, our allocation to India are really more company-specific rather than India-specific. So, on a global basis, we go out and buy companies at various places, even if we don't like the country. For example, in the middle of in the middle of an oil crisis, we were heavily invested in oil companies in Russia because we thought they were tremendous value. So, our allocation in India is really about companies and their respective valuations and their longer-term outlook. As far as what Indian policymakers need to do, I think the requirement from international investors is relatively straightforward. What India needs is a longer-term investment wave, and for that, what you need is structural reforms and infrastructure. Effectively, kind of laying the groundwork so that the flows that come from overseas investors or direct flows can be deployed in the marketplace in a rapid way, and you build the infrastructure around to support that deployment of those flows. That's what we need. If you kind of go back and look at what happened in China, China was recipient of massive global flows, and that helped, along with their own domestic savings, to get their investment to the level that it is today. India needs that in a desperate way for the longer-term growth outlook to pan out.
Right. Krishna, you've spoken about fiscal policy support coming in from the government in the United States, likewise from governments in emerging markets such as India. What would that call for in terms of monetary policy response? We spoke about the Fed. What should the RBI do next? Do they need to cut rates further? The market is going with an expectation of 25, 50 basis points in further rate cuts that would help stimulate growth.
Sure. So I think, again, from a longer-term perspective, in my view, the direction of rates in India is definitely, and all of EM for that matter, is lower rather than higher. The challenge for India is things like oil prices and food inflation ends up being a short-term phenomena that the policymaker cannot ignore. For now, I think my outlook would be that you probably have further rate cuts, but that can change quite rapidly in the Indian context. But let there be no doubt, from a longer-term perspective, real rates are coming down, and as inflation comes down, nominal rates are coming down on a EM-wide basis, and India is no exception.
Right, Krishna, I'll close out with my final question really being, do you think India's profile among emerging markets looks the best? Is it your top preferred emerging market, given that, yes, there's been a rally in EMs from the start of the year till now, especially from March to date, but fundamentally Brazil, Russia, Turkey off late, they are seeing a lot of issues that, investors need to kind of take on board if they're looking at investing in these markets from a long-term perspective. Do you think intrinsically, fundamentally, India is the top market in EMs?
Absolutely. And I think at the end of the day, that is really the most relevant question. India is by far the best growth story in all, in basically any market, not just emerging markets. India has the, global investors want India to grow. Global investors need India to grow. So India has become the number one candidate from a attraction standpoint. The challenge with that For investors, however, is the fact that valuations reflect that to some extent. India is the richest emerging market. So people have kind of voted with their feet with respect to that growth outlook. So I think for Indian markets to do meaningfully better than other emerging markets, effectively India will have to grow at much faster rate, or at least give the hope of a growth that is much faster than what people are expecting right now. And for that, to paint that picture, you need solid reforms on infrastructure and investment front.
Interesting thoughts there, Krishna. Thanks very much for taking out the time to speak with us, and especially correlating U.S. election results with what it means for emerging markets like India. Really appreciate your views and your time as always.
My pleasure.
Well, with that, we come to the end of this edition of The Global View. Thanks very much for watching the show.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.